Welcome to the monthly market commentary. At the Reliance Expert series today, we have with us CIO Fixed Income, Mr. Amit Tripathi, sharing his views for the month gone by. Welcome, Mr. Tripathi. It's always a pleasure to have you here, sir. So recently we had the RBI policy review. What are your takes on the same, and are we expecting further rate cuts in the future?
So there were expectations of some change in language and some acknowledgement from the RBI side in terms of the fact that unlike earlier expectations, inflation has been lower than the projected trajectory, and the fact that as the recent GDP data showed, there has been some growth slowdown in the economy, especially post demonetization. That acknowledgement was made by the RBI. I think the highlight of the monetary policy, so to say, was the sharp drop in RBI's projections for inflation. For example, for the first half of this financial year, earlier they had projected consumer price inflation of 4.5% on an average, which was brought down to 2 to 3.5% range. And even for the second half, where they had actually predicted a 5% kind of number, that was brought down to a range of 3.5 to 4.5%. So there was a sharp drop in terms of the inflation projections by the RBI. So clearly the tone of the policy, if not outrightly dovish, was actually an acknowledgement of the fact that the inflation numbers that we have seen in the past 6 months have been actually always lower than what has been predicted both by the markets and as well as what has been part of RBI's monetary policy fan charts. So I think that clearly was a reasonably good policy from a market perspective, and the market seemed to be reacting to that very positively at this point in time. The second thing needs to be highlighted is that given that the trajectory of inflation and projections have been changed so significantly, if actually, as most market participants expect, at least in the first half and most probably in the second half as well, the economy is going to see these type of numbers as far as headline CPI is concerned, it does open up opportunities for further accommodation from RBI. So while the RBI has not changed its stance right now, it still continues to be in a neutral monetary policy stance, which was started in February. They still continue to be neutral, but market is clearly expecting that if these inflation projections hold, there will be space for rate cuts. And I believe that if this actually holds, there could be space for rate cuts of more than 25 basis points. It could be more in the range of 50 to 75 basis points.
Sure, sir. So recently we've seen a lot of global developments happening, and we've seen it recently. There are a lot of FIIs that have come into the Indian bond market. What kind of an impact does it make?
So as we speak, in fact, the FII limits are close to being utilized fully, both on the corporate bond side as well as on G6 side, which is good news. Now, this overall FII flow has a context. Part of it is linked to India and India macro per se, but also part of it is linked to what's happening globally, both in terms of global macros and global flows. It's a fact that since the beginning of 2017, emerging market flows have been good. India has been one of the bigger beneficiaries because of the strong macro story that India presents. The second is, if I particularly look at the fixed income part of it, now clearly, when the American elections were held in November, there was this big reflation trade that started where people were expecting big fiscal policies from the US, stability in China leading to higher commodity prices. In fact, that was one of the reasons why RBI was also worried about inflation coming back into the system along with post-demonetization impact. That was one of the reasons. That view has got moderated. So the entire reflation trade view has got moderated, which is in general positive for fixed income globally. So in India also it is positive for fixed income. So there has been that rub-off. So one is this rub-off that this reflation trade may not be as strong as what was visualized earlier. So fixed income will be favorable asset class. Second is the stability that we have seen in the Indian currency that has been a hallmark in the past 3-4 years across the emerging market space. And third is the fact that Indian government continues to be very, very constructive, and from a fiscal standpoint, India continues to stand out. So I think India continues to remain that sweet spot for FPIs, and the good news is it's happening both on the equity side as well as on the fixed income side.
So when we talk about the credit space, we've seen a lot of challenges around. So how, how do you manage such risk in your portfolio?
If you look at growth in India, and if you look at how in general the corporate sector is doing, including the financial sector, we are growing at multiple levels across the economy. So some sectors, some companies are doing better than others. There are balance sheet pressures in a group of entities which has nothing to do with industry per se. This could be across industries. Other balance sheets are looking much better. So in general, I think you cannot look at India as one economy in that sense when you're taking credit views. You will have to look at it much more from a bottom-up approach. You have to look at it from an individual balance sheet perspective, and that is where research comes in. You know, today in a 15-member fixed income team at Reliance, more than 50% people are purely into credit research, and the only job that they have is to figure out from this bottom-up approach perspective as to which are the balance sheets, which are the companies where we are comfortable right now from a business and financial strength perspective, and where we have the visibility that this comfort will carry on for the next 2, 3, 5 years, which would then decide on how much tenor we are lending them to. So I think research is a critical part, especially in an economy which is multi-paced economy, especially in an economy where some balance sheets look better than other balance sheets, especially in an economy where prospects of certain sectors stroke companies look better than others. So I think it will be always research led, and you will always have credit challenges in any environment. You know, in this kind of a multi-paced environment, possibly the credit challenges will be more than otherwise, but you have always many options. The second thing I want to highlight, and because this is a very important aspect and we have seen so much of flows coming into accrual funds also in the last 12 to 18 months, is that at the mutual fund level, we are not chasing yields at the cost of credit risk. So it is always a very fine line that you have to draw, that when do you start saying no, irrespective of the risk of losing on that incremental 25 to 50 basis points of yields. Ultimately, our business is first to ensure that the capital is protected, take those views and those credit risks that are acceptable, palatable, can be managed, and will deliver superior returns to investors. So it will never be that we are chasing yields just for the sake of, you know, giving a higher gross yield in the product or a higher return in the product. First is always risk mitigation from a credit risk perspective, whether it is outrightly saying no, whether it is securing the lending through proper governance, proper structures, proper securities, whether it is lending for 1 year, 2 year, 3 year, 4 year, 5 year, whatever the tenor may be. So this is this entire package, obviously led by research and being very careful and having the ability to say no if you don't like a credit. So it is the ability to say no is very, very important in this type of environment where everyone is chasing yields.
So you spoke about accrual funds. As we talk about the accrual focused funds, so when we're seeing the inflation falling in right place, we have a lot of inflows in the Indian bond market from the foreign. How do you foresee the duration focused products and the accrual focused products?
That's a good question, because see, ultimately there are two things that we need to highlight here. When we are talking from a mutual fund context and you are talking about investors coming in and investing debt funds, today if you look at the typical life cycle of a mutual fund investment that an investor has, the typical life cycle is 3 years and beyond, especially if you are looking at medium to long term investments. So whenever we are asking these questions or giving answers to such questions, we have to look at it in that framework, and that is where we always say that asset allocation is very important even within debt funds. Go through all the monthly commentaries, and we have discussed this many times in the past also. It never has to be a 0-1 call. If you look at the history of how government securities fund, GSEC funds or dynamic bond funds have performed in the past, over a 3-year holding period horizon, typically, even in the last 5-6 years, for example, if you look at Reliance Dynamic Bond Fund, the average returns generated have been more than 9%. If you look at Government Securities Fund, it has been even higher, and I can take even longer periods of time of 10-15 years when markets have seen different cycles. So it's not whether I am expecting a 50 basis point rate cut in the next 6 months which should decide whether I should go into a GSEC fund or not. Ultimately, if the overall macro picture remains good, there always has to be some allocation into long duration funds. So whether that allocation is 75-25 accrual duration or whether it is 50-50, that can be changed from time to time depending on your interest rate views, but it will never be 0-1. Given the current environment and given the fact that, if going back to your first question, if you actually go by RBI's projections, there will be space for accommodation, there will be space for rate cuts. You could see duration funds doing much better in the next 6 to 12 months than what we have seen at least between December and February when the RBI changed its stance. And yes, so from that perspective, I would say if you are looking at a 3-year allocation today, I would say if earlier we were at 70-30, today we would be at 60-40 kind of a thing, where duration allocation could be increased incrementally. But it always has to be, again, like I said at the beginning, an allocation between accrual and duration, because carry is also a big driver of overall returns. You cannot forget accrual just because you are seeing 50 basis point rate cuts. Do that allocation. Today I would sense that a 60-40 kind of allocation with a 3-year perspective, 60 going into accrual kind of products, 40 going into dynamic bond fund kind of products would be a good thing to look at.
It's a pleasure, sir. It was very insightful and actually taken up the holistic view. It really sounds great, sir. I'm sure the investors and the viewers would have benefited a lot from this video. Thank you. Viewers may please ask us their questions, email it to us or follow us on Twitter. The details are right on your screen. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.